I mean, the answer basically is that gold and silver go to infinity. I mean, or as good as, unless someone wakes up and gets the mandate, and this is the important thing, gets the mandate to deal with it. Because, I mean, that's the point. It's not a bull market for gold, it's a bear market for fiat currencies. So there's that. The other point I'd like to make is that the geopolitics are evolving really very rapidly. But, I mean, the point is, I think the main point is, and this is something that this guy obviously, doesn't really understand. What's driving silver is people are getting out of paper into physical. And when you have got, 1,000 tons of paper and only 1 ton of physical, you got a problem. So it's the last one to do it is the sissy. And this squeeze is only just starting. You do not get a government regulator, presumably told by the bigwigs in the Central Committee, you do not get a government regulator turning around and telling the institutions, sell your US treasuries.
Welcome to Live from the Vault, brought to you by Kinesis Money. And this is the show that goes beyond the headlines to uncover the truth about the gold and silver markets with world-renowned whistleblower and industry expert Andrew Maguire. And this week, he's joined by a very special featured guest. And yes, we're talking about Alasdair Macleod is in the vault with us here. And we're talking gold and silver, so you're not going to want to miss a second of this conversation. So let's head over to the UK and join Andrew Maguire and our featured guest, Alasdair Macleod. Over to you, Andrew.
Well, thank you, Alasdair, for coming and visiting us. First time, 2026. I cannot believe it. You were a regular visitor with us in 2025, and we've had many, many calls for you to come back. But thank you so much for joining us today.
Well, it's very much my pleasure. And it's early in the year, so, we don't want to bore everybody with my views, surely.
Well, certainly the market action hasn't been boring, has it?
That is very true. Very true.
In fact, I think I'm glad that we're actually doing this interview after the Friday to Friday, should we call it a drawdown? Let's be kind and call it a drawdown. But I think maybe we could start with the silver squeeze, I think, because obviously gold a lot less affected. But the silver squeeze, massive physical shortages, exploding Asian demand. I mean, and this huge decoupling we're seeing between the West and the East. Tell me what you're seeing from your perspective.
Well, I mean, there's so many aspects of this, but so I'll try and boil it down to a few simple points. One point is that there was no speculative interest in COMEX or indeed in London ahead of this. What subsequently transpired was there was speculative interest on the Shanghai Futures Exchange, and quite a lot of that on the short tack. Not long. I mean, this guy was Bain something or other, Shilling or something, short of over 30,000 contracts. Yeah. And what's interesting is that next week is Chinese New Year, Year of the Horse. Markets are shut. Mr. Bain has been told you cannot sell anymore. So the only thing you can do is buy to close or deliver. I'm awaiting the squeeze. I think the squeeze could be quite dramatic at the Chinese end. Anyway, so we'll see what happens there. But the other point I'd like to make is that on this dip, I'm hearing from everywhere around the world that buyers for gold and silver were just queuing up to pick it up deep levels. Now, that's interesting because it tells us that the psychology behind the market now is immensely positive. People are beginning to understand why you should have gold and silver. And the people who are understanding are central banks, governments, let's say some of the super rich, wealthy Asian families. They're not all. The people who may be people with huge, great funds who are close to government and know what central bankers are thinking. And perhaps some old money, which understands the difference between money and credit. Not that many people do, but understand that it's credit going down in value rather than money going up. Because, I mean, that's the point. It's not a bull market for gold. It's a bear market for fiat currencies. So there's that. The other point I'd like to make is that the geopolitics are evolving really very rapidly. I mean, interestingly, China has always taken the view, why interfere with the dollar's demise when the Americans are basically making all the mistakes? Mm-hmm. So really, for the last, 3-4 decades, they've just sat back and let America make all the mistakes. Every time America comes out with something against China, whatever, it ends up, China doesn't get hurt, really, and the dollar gets undermined. People start losing confidence in the dollar. I mean, a good example was cutting Russia out of SWIFT and stealing Russia's central bank reserves. So, literally everything they have done has just backfired on them. And so the Chinese have done nothing until last September. Last September, they finally decided that it was time for them to act. You have a capricious president in President Trump. You can't trust a word he deals with. He changes his mind every minute. He's, 1 minute he's peacemonger wanting the Nobel Prize, another he's all for bombing the hell out of someone or other. I mean, this is unstable, if you like. And it really started with the Chinese saying, okay, rare earths, you're not having them. And literally just stopping the export of rare earths without without an import, an exporter and a foreign country having a very, very good reason to do so and being relatively friendly to the Chinese. I think what's really, if you join the dots, though, it was about the same time that things changed for silver, because until then, China had been happily supplying silver into the market basically to suppress the price. But then they turned around and, America suddenly decided, this is a critical mineral. So China's attitude towards silver changed at that moment quite sharply. And I think various other things too. So what we saw was suddenly there was a liquidity squeeze in London where I think it was October the 9th, you'll correct me if I'm wrong, lease rates shot up to nearly 40%.
Yeah.
Backwardations between London and COMEX appeared for a while. We've had consistently, you would think that this is just a problem confined to us in the West, but no. I mean, actually, the price of silver on the Shanghai Gold Exchange and also the Shanghai Futures Exchange has been higher by significant premiums over ours. So, I think this sort of tells us two things. First of all, the price is actually made in China, not here, which is very, very important. I think the second thing about it is that the supply situation in the West is still dire. And actually what's happening, if you get to the bottom of it, what's happening is that people are getting out of paper into physical. And I mean, when you've got, say, 100 times paper, as you have physical or no physical, I mean, where do you go? And this is why you've got problems in the market. And they've only just begun, in my view. I think it's going to continue because unless the Chinese relent, and I don't think they are, bear in mind that they're now on the warpath. They turned around and told their own institutions yesterday or day before, don't buy US treasuries, reduce your positions. Get out of crypto. We're banning it completely. Anyone who deals in crypto is going to jail, sort of thing. So they're clearing text, in my view. This is classic, absolute classic. So we're into a financial war, and the beneficiaries of this are going to be commodities as a whole, led by gold and silver. And I think that broadly is roughly where we are, Andy.
This is the most detailed insider account of what actually caused the silver crash available anywhere in public discourse. Andrew Maguire has direct CFTC contacts, and Alistair MacLeod has decades of institutional relationships. Together, they describe a coordinated short position on a thin market combined with spoofing, designed to shake out retail longs and paper speculators. The PBOC's anger is the most significant detail. China has been building the SGE as a physically backed alternative to COMEX and LBMA for years. A rogue trader undermining that strategy triggers a severe regulatory response. That short position still needs to close.
Oh, that's really well put, and I think very succinct. And I think the PBOC, my understanding is the PBOC was very, very, very unhappy with this trader that we talked about a little while ago. Really unhappy, because what China's been doing is creating the SGE is physically backed. So if I want to trade, buy or sell a bar on the SGE, I have to own that bar. And so essentially what they created is this very, very stable, as you say, the price really didn't come down a lot based on this huge drawdown. And if one looked at that, and then you see, my understanding is, and I won't use the words that they told me, but they were very unhappy with what happened. And so what this 450 tons, and what there was only 300 tons of supply. So obviously that created a problem, and it sort of pushed back against. So I understand that this trader had other trades had written options positions on the COMEX, had related parties there. And from my understanding, and I do deal with the CFTC, is that the CFTC and their regulator is looking into who the hell. You remember in 2011, there was a sudden amount of puts, a massive amount of puts were put ahead, the day ahead. And what it did was immediately drew a trail to who that was. They were cancelled, obviously, because it was clearly someone who was involved in the whole situation. And although it's not of that scale, my understanding is, and what I hear, is that a huge amount of puts were put on the market the day before this happened. And so I think now the two regulators are going, now what you've done is impacted a regulated exchange in America. And now you've got the two regulators very unhappy. I understand that there's even talking about putting 100% margins on this fund, this sort of long only silver fund. It was the only fund that was silver fund, and it was long only. And I think they're talking about actually bringing margins up to almost to 100%. And I see that from the outside of the markets, they're also stepping up more higher and higher margins based on a percentage. But because they don't have the silver on this side, and they do have the other on the other. So it's interesting dynamic.
I mean, I think, I mean, what you're saying is that he was also running, if you like, call options or call positions on COMEX. So actually what he was doing is he was trying to arbitrage the spread between the two. Do I understand that right?
Well, I think I think they bought a lot of puts.
What, on COMEX? So
yeah.
In other words, he's doubled down on the short position.
Yeah, double down, knowing that it would, and then cancel them out.
What do you mean, spoofing it, in effect?
Yes, spoofing, 100% spoofed. And I think I'm not the only one to think there was massive spoofing going on. We had $5 spreads. I remember looking, I couldn't believe it, Alistair. Well, yes, we've seen $1 spreads in silver before, and it's no big deal. We've seen it in the past. $5 spreads between the bid and the ask on the COMEX. 10 cents it should be, $5 at one point. So clearly it was spoofer's heaven. And you could get away with an awful lot of stuff there.
Well, that's interesting because the Shanghai Futures Exchange issued an announcement that they had identified, I think, something like 145 cases of spoofing and deal washing, I think they called it. I don't know quite what that is. Spoofing, we know. And they suspended quite a few accounts. Now, they didn't say in the announcement specifically what it was, but we assume it was with this big short who was dealing through various accounts or acting in concert with others. Whichever way, there is this huge, huge short position to close. And guess what? The exchange is on holiday next week. It's shut. I mean, I wouldn't like to be in that position of having a position in a very volatile market, not being able to deal for a week. I mean, my goodness, I think that's negligent or stupid, really. So anyway, he's got himself into this position. It's going to be interesting to see how it comes out. But I mean, the point is, I think the main point is, and this is something that this guy obviously, doesn't really understand. What's driving silver is people are getting out of paper into physical. And when you have got, thousands of tons of paper and only 1 ton of physical, you got a problem. So it's the last one to do it is a sissy. And this squeeze is only just starting.
The practice of placing large options positions the day before a coordinated market move and then canceling them is a documented form of spoofing that leaves a regulatory trail, and both the CFTC and Chinese regulator are now investigating simultaneously. The 145 confirmed spoofing incidents on Shanghai alone represents remarkable transparency from Chinese regulators, standing in stark contrast to LBMA opacity. The short position is still open, the exchange goes on holiday, and 1,000 tons of paper claims are competing for physical silver that doesn't exist.
And it's not just silver, but I mean, if you look at all the metals, they are wildly undervalued, measured in gold. Now, you could argue, well, that's because gold has risen, and they haven't. But over the long term, the purchasing power of gold remains relatively constant. And I've worked on a basket of base metals, which is assembled by the IMF, and taking that as, if you like, the basis, I can see that the value of that basket is at only 20% of that long-term value, only 20%. In other words, that gap has got to close. Now, some of it could be gold going down a little bit, but in current circumstances, I think that would be a very brave call. What it does mean, and this is desperately important, it means that even in gold, these things like copper, silver, molybdenum, all these sort of, nickel, lead, whatever, a basket of them is going to go up 4 to 5 times in gold, while gold is rising against fiat currencies, which in turn means that the input, if you like, into producer prices is going to be dramatic in 2026 and even more dramatic perhaps in 2027. And it's not just restricted to, to a basket of metals. I mean, the whole of the commodity complex has been suppressed by the shenanigans, if you like, that go on in paper currencies, and particularly the dollar. That's being unwound. And I mean, energy prices, exactly the same thing. I mean, I can easily see oil shooting up, doubling, tripling. I mean, I'm not forecasting that, but, the dynamics behind it are precisely that. And it's going to be very surprising if inflation, that stupid phrase, which actually is loss of purchasing power of the currency, the fiat currency, it would be very surprising if that doesn't return in spades later on this year. And does anybody expect it? No. They're talking about, we'll get another cut in interest rates from the Fed. Isn't it wonderful? Come on. I mean, this is, the markets are broken. They are completely mispricing everything.
This is the most important macro call in the interview. Alistair is not saying silver is cheap. He is saying the entire commodity complex, measured against gold, the only honest unit of account, is at 20% of its historical value. Copper, nickel, oil, silver, rare earths, all at a fifth of where they should be relative to gold. This gap closing requires commodities to go up 4 to 5 times in gold terms, while gold simultaneously rises against fiat. The compounding effect on producer prices in 2026 and 2027 is almost incomprehensible to markets currently pricing in Fed rate cuts.
And markets always get it right in the end. So, you may think, well, Mr. Market says this today, and therefore that's reliable. It will change. Markets will wake up, and then they'll be held to pay. And that's really why, if you look at, if you want a reason why gold is maybe front-running the dollar in terms of the dollar losing its purchasing power, that's the signal we're getting.
Do you know, it's so interesting. I think you'd say, well, how come everyone doesn't understand this? How come these intelligent market makers, hedge fund managers, you think, well, who have so little exposure to gold? And what it was interesting this morning, pretty much said it all. You can probably watch Bloomberg. And I think at 8:00 in the morning, I was watching, Mark Cudmore, I think his name is. And he said, I'm very grumpy this morning. He said, because I just don't understand the markets anymore. I don't understand. Now, this is their expert. And he said, and the other guy comes in and says, yeah, all the traders that we speak to are feeling the same as you. And you think, hang on a minute. I mean, so because they're saying things like, well, we see the correlations are broken. We see gold going up with the S&Ps. Well, probably because people are hedging, trying to hedge their position. But when the market goes down, the risk markets go down, gold doesn't come down with it. And it's so they just don't understand it. And so because for years and years, the money honeys come on, they know exactly what to talk about when it comes to stocks and what's moving stocks and interest rates and one thing or another. But when it comes to gold, they look vacant. They just don't, and silver, even more vacant. So it's interesting that suddenly we've got an interest coming through from the mainstream is waking up, and they're saying, well, too late almost, because really gold and silver are no longer being priced this side of them, as you've rightly put. They're not being priced here anymore. Being priced in physical markets that have escaped this ring fence. Yeah,
absolutely. I mean, I think the answer to this conundrum. There's several reasons for it. The first is that everybody accounts in dollars or their own currency or whatever, so that when you trade, that's where you book your profits in the currency, and your bonuses are paid on that basis as well. So the idea that actually it's the currency going down rather than, let us say, a basket of commodities rising is alien to traders anyway. And of course, because it's alien to traders, it's also alien to most investment managers, and it's alien to their clients. And bear in mind that, for the last 53, 54 years, 55 years now, people have bought the Kool-Aid from the US Treasury that gold is no longer part of the monetary system. The dollar is the monetary system, and everything is tied to that. I've even had Austrian economists who should know better saying the dollar is money. No, it is not. It is credit. In other words, so there is disinformation. And indeed, going back to Keynes's general theory, he invented macroeconomics in that book, literally on page 16, page 20, something like that. He said basically about Say's law that, if it is wrong, then there's a whole new, I think his words were something like, there's a whole new chapter of economics to be written. That was the basis of macroeconomics. It was all based on a lie. And the idea that statistics can actually tell you anything about the future completely ignores the human element. I mean, these guys just don't understand economics. They're not economists. They're mathematicians. And if they're anything, they're mathematicians. So it's hardly surprising that when the system starts falling apart, they're bereft of ideas and they don't understand what the hell's going on. And I think that's basically what you've been describing.
Yeah, and I think, again, it leads into, what they do is they take gold and silver and say, oh, Well, let's look at the moving averages, shall we? So if it's above the 200, it must come back there. And what they're forgetting is that as we've been saying, that when these long-term moving averages they've been populated, they're anchored in a history where the markets were determined in the West, and they're no longer anchored in the West. So therefore, when you just mindlessly say, well, we've got to pull back because it's above a moving average, they're just not getting the fact that it doesn't. You're dealing with apples and oranges.
No, that's absolutely right. The idea that you can treat commodities.
The Bloomberg moment perfectly illustrates the information gap between those who understand monetary history and the vast majority of professional traders trained entirely within the post-1971 fiat paradigm. When the most senior strategists at the world's leading financial terminal don't understand why gold isn't following their models, that is the most bullish possible signal for gold. It means institutional money has not yet rotated in. The smart money is still accumulating, while the professionals are confused. Alistair's point that gold and silver are not investments, but money is the foundation everything else builds on. You cannot apply standard investment analysis to money. Money doesn't get overbought. The currency it's priced in gets oversupplied.
Particularly as a group, in the same way as you treat, let's say, investment in tech stocks, is completely fallacious. And the number of, as you rightly point out, the number of mechanical technical analysts, who said that silver is overbought or something. Overbought, basically, if they go back and read the books, basically what they're talking about is a situation where there is undue speculation. But where are the speculators? In silver, we've got open interest on COMEX about as low as it gets. As you rightly point out, $5 spreads basically means we're not dealing. We don't want to know. There is no market. The speculators are not there. There may be some in China, and we sort of think, okay, this has been rising and rising and rising, and so the, Chinese love a punt, so they will have gone in there and they've bought it. So, okay, we could shake out a few guys over there. But it turns out they've gone and shorted it. It's absolutely unreal. These are not markets that you can analyze, if you like, in the way in which you would analyze, if you like, an investment. Because gold and silver are not investments. They're money. They're real money. Or commodities. But it's not an investment. And this is where the big mistake is being made. And to try and turn them into investments by coming up with sort of handy things from ETFs to derivatives and all the rest of it is actually getting the whole thing arse about face.
And people forget. And it's in your face every day. Gold and silver traded as foreign exchange cross against the dollar, against other fiat currencies. So it's not just a commodity, it's money. And it's money being weighed up against those crosses. And I think people forget that. And it's none of the analysts seem to focus on, it is actually money. And it's right in your face that it's money.
I think the other thing, Andy, is that nobody actually understands the legal position. The legal position is that gold and silver, or a similar metal, throughout history, has always been final settlement. Where you don't have final settlement without a counterparty on the other side, it is credit. And so what we are seeing is the value of credit changing relative to final settlement. Now, no surprises which way it is changing. It is changing downwards, just the same as every fiat currency in the past has. And every fiat currency in the past has finally disappeared. Now, this is actually what we're now facing. And the reason we're here is because of insurmountable, unproductive debt, mainly in the hands of governments, which require continued growth, if you like. But what is growth? Growth is growth in credit. So the whole thing is actually founded on a basis which is bound to collapse. And that is actually what we're seeing. And so, the idea, going back to what you were saying about overbought, oversold and moving averages and all the rest of it, the idea that you can successfully chart this actually is quite limited. I mean, there are some people who are very, very good at this, and I wouldn't decry their work, but really, this story is about the dollar going to zero unless someone steps in and stops it. And who's that going to be? Who's going to go against the wokeness? Who's going to go against the public demand, the electorate demand to really, I mean, they're less interested in protecting the dollar because, they don't understand what's actually happening. They think prices are rising rather than the dollar going down. So any cuts in welfare, in Medicare, in government spending just cannot be tolerated. You don't buy votes that way. You buy votes by spending more. And that's what the politicians do. And they will collapse it just the same as Helfferich, who was the economy minister in early 1920s Germany, did with the Reichsmark. And the amazing thing about it was that his understanding of economics, I mean, he was one of the top economists at the time, and he presided over the collapse of the Reichsmark. And furthermore, he was the architect of what replaced it. I mean, can you believe it? But today, this group of politicians have not even a fraction of the understanding of economics that Helfrich had. And yet he presided over the collapse of the currency. So what hope have we got? I mean, the answer basically is that gold and silver go to infinity. I mean, or as good as, unless someone wakes up and gets the mandate, and this is the important thing, gets the mandate to deal with it. But nobody's going to get the mandate. It's always a question of crisis first, solution second. And as the history of Germany showed, the solution basically, it was absolutely fine. I mean, it's, the collapse of the currency's purchasing power stopped due in large part to Helfrich's plans and also Helmut Schacht, who then took over the central banking function. They managed to get confidence back into the currency. But this led to Hitler.
Yes.
It's all in Hayek's road to serfdom. There comes a point in this process afterwards, the people demand a strong leader. We want a strong leader. And you get Hitler.
Yeah. Yes.
This is actually something which this is not a journey which is going to end with the collapse of the currencies. I mean, that's on the way, I think, to the future.
Yeah, and I think you're right, and of course I know you're right, and I think that's why we've got the BRICS-centric world trying to take down barriers, trying to get on with each other, and trying to build a multipolar world. And you've got the inverse of that, where actually it looks like Europe wants war with Russia because they're so broken. Their only solution is to, once again, come up with something like a war. And it's ludicrous. And China sits back and lets, as you rightly put it, they just let it sans nous. They let it play out.
Alistair MacLeod is one of the few economists alive today who has both the historical knowledge and institutional experience to make this argument credibly. The key detail most people miss about the Weimar comparison: Germany's currency collapse was presided over by one of the most competent economic minds of his era, who fully understood what was happening and still could not stop it because the political constraints were insurmountable. Von Mises's crack-up boom is the most important concept in monetary economics right now, describing the phase transition between elevated but manageable inflation and the moment everyone simultaneously tries to exchange currency for anything real. We are not there yet, but we are moving toward it.
And you did a marvelous thing today. You put out something which I would encourage people to jump on your Substack and read. It was headed, "China is preparing for the death of the dollar." Please, if you can share a little of those thoughts, because it's so relevant. It kind of sums up a lot of what you've been talking about.
Yeah, absolutely. I think, point which must be made here is that it's not China being sort of overly aggressive against the dollar. She's now in a position where she's got to protect herself. And it's very, very different from, let us say, actually going out and destroying the dollar. Now, her actions are not going to help the dollar, that's for sure. If anything, they will contribute to the more rapid decline of the dollar in terms of its existence as a fiat currency. But she's got to protect herself. I mean, the only thing we don't know yet is what level is she going to tie the yuan to gold. That's yet to be decided. I think the interesting thing is that because they've got strict exchange controls, this is something where, she could have a gold standard, let us say, for international trade settlement, rather like, Bretton Woods was. It was really sort of intra-government dealing, as it were. And also, outfits like the IMF and World Bank and so on were able to demand gold out of, in exchange for dollars. So that was the Bretton Woods system. It's very, very limited. You and I didn't get a look in as individuals. But when it comes to the domestic market, I think that because they've got good exchange controls, they could easily put that on, say, a silver standard, which would require the Chinese to have, first of all, a relationship between silver and gold, which is sustainable. So we're going back, I think, to under 20, probably back to somewhere between 12 and 15, something like that, gold to silver ratio. And, I think the other thing is that she needs to have an awful lot of gold and an awful lot of silver. Now, I can tell you from my research is she's got an awful lot of gold and an awful lot of silver. So, the conditions are in place to do that if she wants to. I personally don't think that's a good long-term solution. But my assumption at this stage is that in common with other governments and other central banks who have been accumulating gold, the last thing they want to do is part with it. And the idea that you offer your citizens the ability to exchange it for your useless paper or your gold substitutes, which hopefully it will become credible gold substitutes, I mean, it's not a risk they really want to take. They want to hang on to what they've got because they realize they've got money and they're giving you credit. So, I think in time, if China can get this to stick, then I think they could probably sort of move towards a better standard for the yuan, rather than just, a Bretton Woods Mark II type situation as I've described. Because, I mean, the point is, and this is shown in Switzerland, if you have a credible gold standard, then your citizens don't have any gold. They don't need it. You only need gold when you think the system's in danger. So, that's the secret. Have the thing credible. Anyway, we'll see what happens. But it's, I think the point, thank you for mentioning that article I released today. I mean, the point about it is that the timescale of the end of the dollar is actually accelerating very, very rapidly. You do not get a government regulator, presumably told by the bigwigs in the Central Committee, you do not get a government regulator turning around and telling the institutions, sell your US treasuries. Now that is quite remarkable.
It's phenomenal, and as you say, not just the institutional institutions out there, by talking about the first tier banks to possibly actually sell some of those holdings. And I mean, that to me, that this is, if you've got a buyer's strike for US Treasuries on its own, let alone dumping anything, but if you've got a buyer's strike, good God, that's a problem.
Exactly. And I mean, it's, basically the Americans have made enemies everywhere. And I think there is a growing reluctance to, take their bonds, to subscribe for their bonds, to hold their bonds. And if you look at the market, I mean, there's On Treasury, U.S. Treasury tick figures, there's about 44 trillion of foreign money invested in dollars and underlying financial assets. Everything from bank deposits to U.S. T-bills, corporate T-bills, longer maturity bonds, corporate bonds, agency bonds, and roughly half of it is in equities. It's just riding the bull market. Now, we all know what foreigners do when a bull market ends. They just get the hell out of it because they've got no reason to be in your stock. They really haven't. There's no sort of strategic reason or anything like that. Why is your portfolio invested in Afghanistan stocks or whatever? Oh, because they're going up. I mean, that's basically the argument. Whether it's Afghanistan or America, it's no damn different. It really is not. They won't realize 22 trillion out of it. I mean, I think that I can see that being sold down, and I can see it being really sold down. I don't know. I mean, the market is so overvalued because of credit, the credits that's been chased into it, and also very overvalued currently against the yield on the long bond. Probably the highest level of overvaluation seen in history, including the 1929 experience. Now, that being the case, there is a lot of downside in the S&P 500. And on that basis, foreigners, how much can they get out of their 22 trillion? I think they probably walk away with less than 10, a lot less than 10. So, and then what does the US Treasury and the Fed do? Well, the answer basically is they've got to rescue the stock market because we need the confidence, if you like, in the stock market, which will be translated into confidence in the economy. This is the mantra which Greenspan was pushing, 25 years ago.
Mm.
And I think what that means is that along with supporting the banking system, stopping companies going bust, all those zombie companies with unproductive debt, out when it was suppressed at zero or close to, interest rates close and bond yields way down there. I mean, corporate America as well as government America is in a huge, great financial mess. And there are two possible ways out of it. Basically, everybody goes bust. Government stands back and says, right, we're not having any of this. It's your problem. Deal with it. Or what they do is they devalue the dollar through the means of the most massive quantitative easing you have ever seen, which is, if you like, a soft default. Those are the only two options. It's a bit black and white, I'm afraid, at this stage. I mean, you can't do a bit of some and a bit of the other.
China's directive to sell U.S. treasuries is not a market event. It is a policy declaration. When the world's largest holder of foreign reserves instructs its financial system to reduce dollar exposure, the cascade effects are impossible to contain. The $44 trillion figure for foreign investment in U.S. dollar assets is the number that should make every investor stop and reconsider their portfolio. If even 20% of that flows out, and China's signal could trigger exactly that, the Fed's only tool is the printing press. Alistair's silver standard scenario with a 12-to-15:1 ratio is the detail precious metals investors need to hear most clearly. If China backs the yuan for domestic use with silver and holds enormous silver reserves, the current 80-to-1 gold to silver ratio is not just wrong, it is catastrophically wrong.
Absolutely. So if you need a high quality liquid asset. You need something you can collateralize. You need something that you can hedge, you can use as collateral. So if you're not going to have a US Treasury bond, what's your other alternative? There is only one that I can think of.
I would question the need for collateral. I mean, yes, if you're a bank, yeah.
Yeah.
If on the other hand, you are an individual trying to protect your wealth, you want to have physical possession of your gold and no one having a lien over it. I mean, it's as simple as that. Banks are dealers in credit. Okay. In fact, because they're dealers in credit, they don't really want to hold any gold at all. It's not their problem. Their problem, that problem is the central banks. The central bank has got to tie the value of credit to gold. Fat chance of that. But, as far as the bank is concerned, they're dealers in credit. They create credit, if you like, to lend to someone. and balance it with the deposits and take a spread out of the rate differential. That's their business. But I think for people like such as the ones I advise, I mean, the answer is quite simple. You just hoard your gold, hoard your silver, sit on it securely out of the banking system. Don't leave it in the banking system, for goodness sake, because if things really do go wrong, it's liable to confiscation. It's liable to, and if a bank goes bust, I mean, the number of times I've seen businesses go bust, and there's a confusion, if you like, in the mind of the administrator or the receiver about the ownership of assets. They will treat it as property of the company, if you like, and if you've entrusted it with the company being a financial institution of some sort, like a bank, then tough. You got to fight trying to establish your ownership of it. And this is something which has created all sorts of problems in the past. Don't go there. It's a short answer.
I think China's done a much better job of doing what Basel III was supposed to do, which is create high-quality liquid asset, a first-tier high-quality liquid asset. Because there's always the games going on over here. You've got the forwards market, you've got dilution, maybe 20% dilution. Up to that, we probably figure that isn't compliant. And when you have a fix, the 3 to 5 tons out of the 800 or 700 or 800 tons that get traded every day in the FX markets, maybe the 3 to 5 tons is compliant. But that's a tiny, tiny portion of what's going on. Whereas China has now the refiners I know and deal with, I'm sure you do, producers. Why would you use the Western markets when you've got the gold and silver corridor, you've got the gold corridor, it's physically backed. You know that anything within that vaulting service and everything that came into it and is coming out of it is a physically backed gold and silver. Therefore, if I want to hedge something, forward production, whatever, why would I touch this Western toxic mix of derivatives when really all I want to know is what's my price? What is the supply demand price? How can I hedge that better? Therefore, if I park my business in a Western facing high quality liquid asset gold market, SGE facing market, no wonder open interest is evaporating. No wonder it is. It's going to places where it's safe.
Yeah, and I think the other thing is that the standard of regulation in China, I think, is without fear or favor. And that's something which we can't really say in our markets. I mean, the LBMA is horribly secretive about what goes on. And when you look at COMEX, I mean, it would appear that COMEX is actually, sort of run by the big banks. I mean, the big banks are free to do this, free to do that, and all the rest of it. Which is often in contravention of the rules, and certainly in contravention of the spirit of the rules. It doesn't quite work like that in China. China actually has jumped down, and this is an important point. This week, it has jumped down on the spoofing, short selling, all this sort of stuff, and is making life for people who don't play by the rules extremely uncomfortable. I wouldn't be surprised if some of them end up in jail, quite frankly. But anyway, that is something we've yet to see. But I mean, the regulatory environment in China, I would say, is streets ahead of us in terms of being, if you like, the user of the market, being able to trust the market.
Absolutely, and that is the sense I get from all the institutional people that I deal with on a day-to-day basis. They say, now you've got the free trade zone, you've got the same regulations coming in. So if I want to offer my silver for sale, then I'm pretty sure I'm going to get a supply-demand price as opposed to a derivative influence price. And so I think that to me that it's done. they're toast. I mean, so any bank still using an asymmetrically imbalanced hedge, like in other words, we'll take this COMEX short position and we'll hedge it. Let's hedge it in London, so that as far as the CFTC is concerned, it's hedged. So you're compliant. But hang on, that position is paper. It's a paper position. So you've got paper hedging paper. So to me, it amazes me that the compliance officers of these banks aren't pulling their hair out and saying, you need to back out of this stuff.
Well, the assumption basically is, I mean, certainly on COMEX, that, you've got a regulated exchange and therefore positions there are regulated investments and all the rest of it.
The paper hedging paper point is the structural vulnerability at the core of the entire Western precious metals market. A bank short silver on COMEX and hedged with a London paper long has not hedged physical risk. They have created a paper net zero position with zero actual metal behind either side. When delivery demand rises beyond what can be supplied, both sides of that hedge fail simultaneously. The SGE comparison is critical. China built what the West should have built but couldn't because it would have exposed the fraud. A market where every bar that trades physically exists and is vaulted is the only honest precious metals market. Capital is migrating there.